Notes to the statement of cash flows. The first note that we need to look at is the cash generated from operations. Last lesson, you were shown how to use the direct method to calculate this amount, although it is not examinable. However, you do need to be able to calculate this using the indirect method, which involves working out a note called reconciliation between profit before tax and cash generated by operations. Yes, this does seem like a very long title for the note, but in actual fact it explains exactly what it does. What you need to do is take your profit before tax that you would find on your statement of income, and you do a number of adjustments in order to reconcile it with the cash generated by operations, which is the figure that you will need on your statement of cash flows. The things that you will need to adjust for are firstly depreciation, because it is not a cash item. If you had other non-cash items like profit or loss on sale of asset, these would also be included here. Because they are not cash items, they affect the amount of money that you receive from your profits from cash. And remember, we are only looking for the cash effects. So therefore, if we start with our profit before tax and add back depreciation and other non-cash expenses, we are going to be more likely to get the accurate amount that we need for cash generated by operations. The second one that we are going to add back is our interest expense or finance costs. These amounts for interest or finance costs, remember it means the same thing, are cash amounts. However, they are not operating activities directly. Although they are short-term and we do want to use them in this section, we want to exclude them from all our operating activities, and instead we want to show them as an individual amount on the face of the cash flow statement, together with dividends paid and tax paid. In order to be able to do that, we need to exclude it over here. Once we have taken our profit before tax and adjusted for depreciation as well as interest expense and finance costs, that will then give us our operating profit before changes in working capital. Then we need to take into account the changes on the statement of financial position for our current assets and current liabilities, in other words, our working capital. We will need to look at the changes in inventory, changes in debtors, and change in creditors. For these amounts, you will look at the statement of financial position and look at how they either increased or decreased between the beginning of the year and the end of the year. If inventory increased, it means that we would have bought stock, and as such there should have been an outflow of cash, and therefore an increase in inventory will be shown in brackets as an outflow of cash. The converse is also true. If inventory decreased, we would show it as an inflow of cash. Debtors will behave in exactly the same way. If debtors decreased, it means that they paid us, and therefore it's an inflow of cash. Although an increase in debtors doesn't feel like we are paying them, the net effect is exactly the same, and so an increase in debtors will be shown as an outflow of cash. However, creditors does exactly the opposite. Think about it like this. If you pay your creditors, you would be paying money out, and therefore a decrease in creditors is shown as an outflow of cash, whereas if creditors increase, it means that in effect we are receiving money because they are financing something that we are doing. This can also be understood better if you consider the accounting equation. Both inventory and debtors are assets. As assets, that means that they are on the same side of the accounting equation as cash, and therefore, if inventory and debtors increase, cash must decrease and be shown as an outflow. However, creditors is a liability on the other side of the accounting equation, and so if creditors increases on the one side of the equation, cash, an asset, will increase on the other side of the equation, and so it would be an inflow of cash, and a decrease in debtors would be an outflow of cash. These amounts are then all added together or subtracted if they are shown in brackets to get the total changes in working capital. Changes in working capital is then added to the operating profit before changes in working capital that was already calculated, and the net effect is shown as cash generated by operations. This is then the figure that you would show on the statement of cash flows. The second note is the note for cash and cash equivalents. This is quite a simple note to do, but it is very important as it shows how the different cash items changed from one year to the next. Quite simply, you will list your bank cash float, petty cash, and any other cash items for year one, and you will list the items in year two. Note that if bank is in overdraft, so either for year one or year two, you would show that amount in brackets. You will then calculate the change between year two and year one by simply working out the difference between them in order to get the net change. If the amount is shown here as inflows, obviously that means it was a positive effect and the cash increased. If the cash decreased, obviously this net change would have to be shown as an outflow in brackets. This final net change shown over here should be all the net changes added together and should also be the same as the difference of the total of year one and year two. This is another way that you can check yourself, and this amount should be the net change in cash and cash equivalents shown on the statement of cash flows. Consider this cartoon. Why do you think this gentleman is threatening to send someone round to fetch the cheque instead of picking it up in the post? Well, there are a couple of issues here. Firstly, in this day and age where we don't really use cheques, you might not be familiar with the idea that if somebody says the cheque is in the post, they might actually not be telling the truth. It used to be a very convenient way to convince your creditors that you had paid when in fact you actually hadn't yet sent the cheque. In this case, you can see this gentleman is not trusting his debtor, and instead he says, no, rather instead of sending it, putting it in the post, I'll send someone to fetch it. He's sending someone who looks rather threatening and ominous to fetch the cheque. I imagine the debtor might consider that this person might beat him up if he doesn't actually pay the money. Why do you think this man is sending someone around and taking his debt collection quite so seriously? If you have a look at the diagram in the background, you can see that the cash flow is on the way down. This is an indication or an illustration of how debt collection is so important in keeping your cash flow on the up and up. Let's look at example 5.5. The first piece of information given is that the profit before taxation is 45,000 Rand. That will be shown as the beginning of this note. Just a little hint, if you can't remember how to lay this note out, look at the heading of the note, reconciliation between profit before taxation and cash generated from operations. This is a good clue for you to always put profit before taxation as your first line and cash generated from operations as your last. Remember that your profit before taxation would be obtained from the statement of income, the line before tax. The second piece of information tells you that operating expenses are 33,500. We're not worried about that amount. However, we do care about the fact that it includes depreciation of 9,000 Rand. This 9,000 Rand is not a cash expense, and therefore it would not have been paid out. As a result, in order to get cash generated from operations, we need to adjust by adding it back. We also need to adjust for adding back information number 3, the interest expense of 1,500 Rand. Remember, I've just told you we need to add back our finance costs because they are financing costs, not operating costs. Pieces of information, numbers 4, 5, and 6, tell us about our changes in stock, debtors, and creditors. To get these figures, we would consider the changes on the statement of financial position. We would look at how inventory increased or decreased. In this case, it increased and must be shown as an outflow of cash. For debtors, we would consider how our debtors changed. In this case, it would have increased by 45,000 Rand. In other words, we have more debtors than we had at the beginning. Again, this would be an inflow of cash. And lastly, an increase in creditors needs to be shown as an inflow of cash, because if creditors are lending money to us in effect, we have more cash. These are all shown as changes in working capital. We also need to take into account the beginning information that the business has an unfavorable balance of 20,000 Rand. That is shown as our bank overdraft in year 2. Notice it's a bank overdraft and therefore it needs to be shown in brackets. Pieces of information number 7, 8 and 9 give us the rest of our information for cash. Petty cash at the beginning of the year is 300 Rand, so that will be shown over here in the column for year 1, 300 Rand. And number 8 tells us that our petty cash changed to 500 Rand. In other words, there was an inflow of 200 Rand in petty cash. The net change in cash and cash equivalents was calculated in the cash flow statement as an outflow of 10,500 Rand. That is shown over there as our net change at the end. From this, you are then able to go and work out all the other pieces of information. In note number 1, we will work down with our profit before tax, add back depreciation interest to get the amount of 55,500 as operating profit before the changes in working capital. Once you have worked out the changes in working capital by adding all these figures in the box together, you will see over here that the changes in working capital were a net outflow of 52,000. In other words, this business is pretty much in the same position as was shown in the cartoon, where their debt collection is not that great. You can then take your operating profit before changes, add it to the changes in working capital, and you will see that the overall effect or cash generated from operations is only 3,500, which is in fact a lot less than we would ideally want it to be. We can calculate the figures in our cash and cash equivalents by looking at the change in petty cash must obviously have been an inflow of 200 Rand. We can then also work back to find that the net change in bank must have been an outflow of 10,700 Rand. At the same time, we could work out the total at the end of the year as 19,500 Rand and then work backwards to find that the total at the beginning must have been a negative 9,000 Rand. From this, we can work back to find out that our bank overdraft must have been an overdraft of 9,300 Rand, either by working from the end result, taking petty cash into account up, or by looking at the net change in bank, knowing the end result and working back to get the beginning. You now need to go and try exercise 5.6 on your own, and then remember to mark it carefully from the solutions book.